Your Royal Highness, ladies and gentlemen, it is an honor to be invited to represent the dismal science of economics today, except I'm not dismal. I'm optimistic I can explain the nub of the problems of finance and sustainability, as well as point to the solution, all in 10 minutes. First, the problem. The finance industry has always been important to this country, and we're quite good at it. But in recent decades, global finance has come off the rails. Its role is to channel savings into productive investment. As such, it is a utility, just like water or gas. Yet finance has become the world's largest and most highly paid industry. It doesn't even perform its basic function well. It is obese, unnecessarily complex, opaque, exploitative, and prone to crashes. And the food chain of intermediaries leaves only a few scraps for the end savers. The finance sector is fueled by capital provided by savers. Savings institutions such as pension funds, represented here in large numbers today, are the collection point for savers' capital. And these funds set the terms for how it is allocated and used. Immediately, there's a problem. Astonishingly, the bulk of investing by pension funds and other savings institutions is now conducted without reference to fundamental value. Passive investing is supine by definition. But funds are also allowing, even requiring, the bulk of active investment to be conducted without reference to the earning power of the assets. There are only two strategies for investing. There's fundamental investing, based on expected future earning streams and dividends, and momentum investing, or trend following, which considers only short-term price changes and disregards value. Momentum investing has come to dominate, both for short-term gain and short-term risk reduction. Momentum is the main cause of bubbles and crashes. The choice between these two strategies, fundamental value and momentum, rather than the length of holding period, is the key to understanding short-termism. And in the context of this evening's meeting, the laudable aims of the sustainability movement cannot flourish when investors disregard fundamental value. How has this come about? Academic finance teaches that competition among investors ensures that prices reflect fundamental value, that capital markets are self-stabilizing, and that excess profits cannot be earned. But a theory that predicts perfection cannot explain departures from perfection. The natural sciences have similar such special and limiting cases, a vacuum, zero gravity, zero friction, but relax these assumptions to build general theories. Bizarrely, the efficient market theory attempts single-handedly to inform the general understanding of how finance works. It also provides the instruction manual for how practitioners invest and policymakers regulate. Pension funds use this manual based on the efficient market theory to select benchmarks, control risk, choose strategies, and write contracts with managers. Yet the prevailing academic paradigm cannot even explain momentum and is silent on choice of strategy and short-termism. No wonder the financial world is in the mess we find it. Academic theory has assumed that investors invest directly in securities. At my centre at the London School of Economics, together with Highness, who directs the centre, we're working to develop an alternative model of finance by recognizing that individual savers delegate responsibility for investing to others. Individual savers are the principals, while fund managers, banks, even pension trustees are the agents. The new theory explains mispricing, momentum, bubbles and crashes, and other long-standing puzzles like value and growth, under and overreaction, and indeed why, perversely, high-risk stocks offer a lower return than low-risk stocks. The new theory that's emerging enables investors to compare the risk-adjusted returns to different strategies and strategies and implementations, something they haven't been able to do except empirically in the past. We show that momentum, trend following, can be justified only for investors with short horizons, and that fundamental investing wins out in the medium and long run. Put simply, trying to do the best each year is a recipe for doing badly in the long run. Policy implications spill out of this work. It shows that almost everything practitioners and policymakers are currently doing is diametrically wrong, and both privately and socially damaging. The new instruction manual for operating in inefficient markets indicates the appropriate benchmarks for active and passive investing, the best choice of strategy, the correct way to manage risk and diversification, and guidance on the optimal design of contracts between pension funds and their managers. Just a few examples. Global GDP plus local inflation makes a sound overall benchmark instead of a market cap-based benchmark, while risk should be specified in relation to cash flows rather than just prices. And the easiest way, the simplest way to reduce momentum investing is to cap turnover. Instead of 100% turnover of stocks a year and bonds a year, cap it at 30% per annum, and the authorities to remove the tax exemption for funds that fail to do so. Funds adopting these strategies through choice rather than coercion will be rewarded with higher medium and long-run risk-adjusted returns, irrespective of what other funds are doing. There's even an early mover advantage. And as the number of funds shift to the new guidelines, the finance sector will become more stable and less prone to crisis, and sustainable policies will flourish. The obstacle to implementation of a new regime are formidable. Vested interest, closed minds, timidity, and the army of lobbyists for Wall Street and the city. There is a general recognition that finance needs to be more long-termist, but so far there have only been platitudes and exhortation from the likes of the G30, the G20, European Commission, OECD, and others. What is needed is a code of best practice for sovereign wealth funds and public pension funds devised and overseen by the International Monetary Fund. The code must have a theoretical foundation along the lines I've just described. As public funds set the example, private funds will follow suit, keen not to miss the boat, content to follow a sensible herd, or challenged by disgruntled beneficiaries. There should be corresponding codes for corporations and regulators. Corporate managers are guilty of pandering to the short-termism of investors, as well as their own short-term ends. They too need a demonstration of the importance of long-termism in selecting projects, in the choice of funding, and in their personal rewards. Regulators should encourage the adoption of the Code of Best Practice and should end the inconsistency of preaching long-term investing on the one hand and imposing short-term mark-to-market valuations on the other. To conclude, principal agent problems and a flawed theory and understanding of finance are bringing capitalism to its knees. A new interpretation of finance points to the critical role played by those responsible for society's wealth. Ladies and gentlemen, you. Thank you.